A very good evening to you traders. This is Mark here from the Day Trading Room. Time is approaching 8 p.m. London time on Monday the 21st of January. A belated Happy New Year to you. It's been a while since I've done a video, and current conditions are interesting. The ranges are very, very low at the moment. Let's just bring in a 5 here and we'll have a look at it. Ranges are very, very low at the moment. We've got market at multi-year highs, VIX at multi-year lows, and we can definitely tell the VIX is low. The ranges are very, very narrow. We did a bit of range expansion on Thursday and Friday of last week, which has perhaps set the scene for some more interesting action going into next week. So we'll have to see if that spices things up. But really, the latter part of the prior week and the first part of last week, very, very low range, very quiet. So you've got to pick your spots a lot more carefully. You've got to change your strategies. You've got to trade the market that you're given. For me, that means much fewer trades, trying to pick those sweet spots, trying to increase my edge however I can, and just really appreciating the conditions and the overall movement of the market, and the targets, the likely targets, and all that. So not so many trades, lots of reversion to the mean type trades, a couple of continuation trades on the first part of the new year. But one particularly I wanted to focus on, which the reason I want to focus on this trade is because it comes up time and time again. It's one of those trades that you're bound to get it once a month, if not once a week, depending on the conditions of the market. But it's one of those that sets up nicely, and if you can get on the end of it, then it can be a good start to the trading day. So what's the setup? Well, let's have a look at the backdrop first. This was basically the prior day here. Let me get the drawing pen out. I won't change the chart. But the prior day, this day here, was the fiscal cliff gap up. So it was a very, very strong day, 300 plus points on the Dow, and closing on the high. As you can see here, that's the high of the day, and that's indicated by the dotted green on the next day, and the close wasn't far off that high. Okay, so that sets the scene for the day as I'm coming into it here. So when we close on extremes, the likelihood is of us testing the prior day's high or the prior day's low. So example, if we have a good strong day and there's the high, the likelihood of us testing that level the next day is very, very high. Good odds of us doing that. Similarly, if we have a heavy down day, put a low in there, close not far off the lows, the likelihood of us testing that low the next day is very, very high indeed. So this is going to be overnight action basically. The difference obviously between where we open up and where we close is the overnight action. So the idea of the trade is, once you've had a strong day in another direction, in this case obviously it was the upside, is to say to yourself, okay, we've got a good high likelihood of us testing the prior day's high, so now I need to work back from that and try and position myself into a trade with the least risk possible. Now, it's not enough as day traders to say we've got a price target, we know where the market's going to go, or we've got a good idea the market's going up, we've got a good idea the price is going to hit this level. We have to actually, as day traders, find a good entry point that quantifies and reduces our risk as much as possible, because without that, otherwise, we could be sitting through an awful lot of heat, and it's not going to make sense in the long run doing that. That part of the game and part of our job is to look for those high probability setups and then work back and try and find the trigger to get into that trade. So when I came into that day saying, look, we've got a high probability of us tagging that, I need to position myself and do something. Now the open was around here, so it's not that far away, and don't forget these are only 20-point boxes, so that's not that far away. It's less than 20 points away, so not much meat in the trade. If we'd have blasted off to the upside, consolidated, there may have been a scalp opportunity there to grab it and possibly look for some sort of extension and explosion above that high, using that as a primary target. So that possibly could have happened, and if that happened, then maybe I wouldn't have got on it, or maybe would have got a bit. But we've got something which is a lot better for making this trade work. It requires a little bit more observation, a little bit more timing. You don't want to get caught out buying straight at the open. but ultimately it gives you a chance to quantify the risk and look for that setup. So the market drifted lower here, which is okay. I'm aligning myself with the long side, and that's something I've been doing, having a bias, a very strict bias, going into the next day and saying, okay, I'm going to wait for that setup to occur. I'm not going to take the short on the drive lower. I'm going to wait for that to run its course and then look for the long, which is what I did going into this day here. And I'm looking for the long, and we're coming down, and we put in this wick down here. Now, considering we've gapped actually down and we're negative on the day, that solid red there is the prior day's close. The ticks are acting okay. They're okay. They're a little bit flaky in the first few minutes of the open, so you've got to be a little bit cautious how you use them. But generally, that's not too bad. They're behaving quite well there. We came down and we put this little wick in on the 1 minute. Now, if we'd have been several weeks into the new year, I would have probably been taking that as soon as I see that tape strength coming in. That's my sort of setup. I like that sort of thing, getting on that, reading that. But because we're a second day of the new year, I'm just being very, very cautious. I'm waiting for some extra confirmation that the trade is okay, and if I miss it, I miss it. That was my thinking back then going into the new year. Just being very cautious, starting out on the right foot, not wanting to have to undo any damage in the last part of January. That's the last thing you need. So came down, put a wick in here. Let's get the drawing pen out again. We put a nice little wick in here. So there's your level to work off. I mean, that's the great thing about wicks and things like that after drives, is you've then got a line in the sand to work off, and you can look at the market relative to that point. So as it pushed back up here, it rolls back over. I'm watching. We start to then hold here. At this point, we've come a long way from the open, relatively speaking. Don't forget, this is still quite a narrow range market. Relatively speaking, in the first 4 or 5 minutes, we've come a reasonable long way, and we've retested, and now we're finding a little bit of support on the tape there. So I can look at that and say, okay, my risk is quantified. My obvious place for the stop is going to be under this wick, because the point of a wick is if it truly is a wick, it shouldn't be retested. So bearing in mind I've got a nice target up here, there's the buy, adding again there, so grabbing a couple of handfuls here as the market shows me some strength in my direction. Take that, add out there as we pushed up above that high. Just basic risk management, just ensuring that I'm taking some off the table based on the read of the tape at that point, and then allowing the majority of the position to mature for that final target if possible. And then ultimately, this is probably where, well, it was where I made a bit of a mess of the trade. Took another scale out here just because we were consolidating again, and we pushed up and just trying to scale out into highs. I was hoping at this point now that after we'd done some consolidation, we were just going to then really take off and take out and go to those highs, and I would have taken it all out of those highs. That was what I was looking for. We'd had this consolidation here, but a push back up. I was hoping now that the sellers would get fed up and the buyers would step in, and we'd have an immediate drive. We didn't get that, and we got this sort of little bit of a chop, a little bit of a drift back down, a little test under the VWAP. That held. I mean, that's all good. These ticks are still looking very, very healthy, but that made me a little bit impatient about the trade. No real excuse for it. It was a little bit of an impatient exit, and when I saw these high ticks and I saw that little tape seller there, I ended up taking the whole trade out. Something definitely be working on, just trying to stick through all this sort of chop and retracements and stuff while the trade is okay. And ultimately, if it had a trailer of 20 ticks or so on that, you'd have probably been fine. But I got a little bit impatient and took it out. I seen that tape seller there and took it out, and I missed out on the last sort of whatever that is, 15 ticks of the trade, which is unfortunate because it did hit that price target. And even if you were sitting there, you didn't get the fill. You would have got the fill later on there and hit that prior day's high as we expected. So overall, it was a nice setup. It's something that you look out for. Always look out for those. Good entry. Risk is quantified. That's what you can ask for. If it stopped me out, fine. It's not a lot in the scheme of where the final target is on the trade. Took some out to first pulses, managing the risk, and then ultimately a little bit of a impatience on my behalf there, taking the trade out there, but it's never perfect. Trading's never perfect. We're never perfect as traders. It would have been nice to hold it for that high, and ultimately that was my target. That was the thesis of the trade. But hey, sometimes you do things that aren't quite as you would want to. Hey, when you're trading, especially first part of the new year as well. I think I was more keen and urgent to get stuff, get good trades under the belt, and approach it from that rather than stretching myself. Okay, so one thing I wanted to mention quickly is going forward. I made some changes to the site. Go and have a look at the site, daytradingroom.com. Check out all the changes that are on there. But the important thing is going forward now, I'm going to be sending out these trading videos that I do to my mailing list here. So if you're not on the mailing list, go onto the site, daytradingroom.com, stick your name in there, usual thing, name in there, email there, sign up, then that puts you on the mailing list and you'll get all the trading videos that I do. I'm going to just start to phase out YouTube going forward and just stick them all on the mailing list. So make sure you stick your name and email address down there. Okay, traders, well, manage risk as usual, keep the risk managed, and we'll look forward to a very successful 2013 trading year. But I'll be back in another video soon. Take care, bye bye.